a cooling pattern has settled over the market. Fear is evaporating faster than volatility traders expected. The VIX compressed while safe havens underperformed and speculative leaders showed mixed vitality. What signals does this combination reveal about investor positioning? Complacency has taken root as measured by a 6.44% VIX drop, the most significant compression in weeks. Major indices advanced modestly, while speculative leaders like ARKK shed 38%, and XBI dropped 3.09%. The data is screaming that investors are rotating into established tech winners, MAGS plus 2.9%, XLY plus 1.12%, rather than chasing high beta momentum plays. Portfolio exposure to pure speculation has weakened while consumer discretionary strength suggests earnings quality matters more than sentiment today. High-yield credit barely moved. HYG gained 0.05% and high advance 0.28%, indicating lenders are pricing instability. The engine sector reflects this calm. SMH shed 1.85% as Apple's memory shortage warning created supply chain uncertainty, while IWM flatlined at 0.67%. Our metrics confirm capital is avoiding leverage. KORE barely edged up 0.11%, suggesting distressed credit isn't driving the market yet. The consensus among the Canary community is that yield markets are masking underlying fragility. Volatility products flatlined across the board. UVXY 3.76, VIXY 2.33 puns, and VXX 2.83 puns all retreated as traders priced instability. Fear has been flushed out cleanly, but not by a catalyst. The indicators are signaling that fear compression preceded this rally, which means complacency is building on thin fundamentals. When UVXY underperforms alongside rising oil prices, 342 PANA, the Canary dashboard shows hedging activity is drying up. Investors aren't buying insurance against downside anymore. Crude oil spiked 3.42% to 86.45, while gold retreated 1.45%, creating a classic risk-on divergence that historically precedes economic softening signals. The Russell 2000 underperformed at 0.5%, suggesting small-cap exposure is being trimmed as capital concentrates in large-cap tech-quality names. Our data indicates the real economy isn't driving this move. Instead, IWS GOST, KHI business momentum, and Apple's earnings guidance are creating sector-specific headwinds that are flowing through to broader indices. Gold's 1.41% decline alongside flat bond performance, 0.33, as it reveals investors are abandoning traditional safe havens entirely. TLT retreated 0.65% as duration traders rotated out of protection, while XLP shed 0.44%. The safety trade is showing vulnerability. When UVXY and GLD underperform simultaneously with rising oil prices, the portfolio's defensive layer is thinner than it appears. Bond dropped 0.33%, confirming that even fixed income isn't attracting significant capital inflows today. The hero, portfolio, faces a complacency threat from the villain, market overconfidence. Clean technicals are masking deteriorating fundamentals. Oil prices rising, gold retreating, and volatility products cooling suggest investors aren't hedging against what's coming next. The data confirms that earnings quality is outperforming sentiment, which means Apple's memory shortage warning and AWS momentum will create the real market moves before macro headlines do. The Canary Report verdict. Complacency has peaked while fundamentals remain mixed. Protect exposure to quality tech names, but reduce pure speculation until oil stabilizes. The next 48 hours will reveal whether this cooling is temporary or the start of a deeper rotation. This is your pulse check from the Doctor of the Market.